Oil prices seem to have stabilized since last week's report, and there seems to be no alternative in sight at the current stage. Today, we are to take a look at the data of the US oil market, OPEC's intentions, and the demand side of the international oil market. For a rounder view, we are to conclude the report with a technical analysis of WTI's daily chart. We make a start with the data on the ground of the US oil market by noting that the Baker Hughes oil rig count showed that the number of active US oil rigs contracted by 1, reaching 478. On Tuesday, AP reported a substantial increase of US oil inventories of 4.7 million barrels, a figure eclipsing the slight drawdown reported by the prior release of minus almost 100,000 barrels and implying a slack in the US oil market. It should also be noted that yesterday EIA reported a narrowed increase of US oil reserves. Nevertheless, we still see the production levels were able to surpass aggregated oil demand in the US. Thus, we do not see any tightness arising. We expect that should there be any further indications of further easing of the US oil market, it could weigh somewhat on the oil prices in the coming week. On the supply side of the international oil market, we note OPEC's intentions as a key driver for oil prices. We are skipping the comment of the head of the Oil Production Alliance that oil is a gift of God and have a look at what the organization seems willing to supply the market. Recent articles highlighted that OPEC Plus has little room to maneuver regarding its production levels as weak demand tends to weigh on oil prices. Please note that the Oil Production Organization had initially planned to start rolling back oil production cuts over the months of the coming and next year. For the time being, we see the case for OPEC Plus to delay any increase in oil production beyond 2024, possibly also beyond the first quarter of 2025. Further signals from OPEC Plus pointing towards a delay in the increase of oil production are expected to provide bullish signals for oil prices. On the flip side, though, we do not expect OPEC Plus to proceed with even deeper oil production cuts either, which could be a relief for oil traders. Regarding oil demand levels, we tend to highlight the two main oil consumers in the world, namely the US and China. In the US, oil demand seems to be weak, while the manufacturing sector may have a decrease of economic activity. On the other hand, China's manufacturing PMI tend to suggest that its factories are struggling for economic activity, showing only marginal increase for the past month. On a more direct indication for the oil market, China's analysts estimate that crude oil imports may reach around 11.4 million barrels per day in the current month, showing a new peak since August, according to analysts, which we view as a positive. Overall, should we see signs of increased activity in the manufacturing sectors of both the US and China, it could have a positive impact on oil prices and vice versa. WTI's price edged low last Friday, yet bounced on the 66.8 support line and stabilized in the midst between the S1 and the 72.2 resistance line. We tend to maintain a bias for the sideways motion to continue between the pre-mentioned levels, given also that the RSI indicator runs along the reading of 50, implying a rather indecisive market that may allow the sideways motion to continue. For a bullish outlook, we would require the commodities price action to break the 72.2 resistance line clearly and start aiming for the 77.85 resistance hurdle. For a bearish outlook, we would require WTI's price to drop below the 66.80 support line, with the next possible target for the bears being set at the 61.65 support barrier. We hope that you found this report useful, and from all of us here at Iron Effect,